She joins us from Durham, North Carolina. We just spoke to Stuart and Ira about retail sales today, and what we heard and what we're getting in the data is a little different than what we're hearing from companies right now about their customers. How would you describe the U.S. economy?
Well, I think it's a mixed bag, particularly when you're talking about households. So we've been hearing about negative consumer sentiment for, really the past handful of years. What has changed is the actual household financial conditions over that time. So bad sentiment right now, paired with a little bit of increasing household financial fragility, is concerning. Now, we know asset holding consumers continue to drive spending and economic growth, but an increasing share of American households are dealing with more affordability struggles and difficulty managing their debt.
Which households? Is it, I want to go back to this Bloomberg story. It's really great. It's Porsche, BMW, and Dollar Tree. And it talks about Dollar Tree targeting richer towns. And they say, the company says, shoppers who make over $100,000 are driving much of its current growth, with 60% of new customers making at least six figures and spending $1 more per visit on average. I mean, I don't know. What does that tell you? Anecdotal evidence? But does it say something about the consumer, even the wealthier consumer?
Well, I know very few people, even high earners, that aren't interested in a deal. I think the people that spend and aren't interested in spending less where they can are a very, very small portion of the American consumers, but they do make up a large portion of consumer spending. And I do think it's anecdotal. It's interesting when you talk about sentiment and consumer sentiment about the economy in particular, it's always a bit of a confusing picture. For example, we asked late at the end of this past year how people were feeling about their finances going into the new year, and roughly a third said they felt optimistic or confident, and about the same share said they felt anxious or stressed. So not only are feelings going to differ from household to household, but it's entirely possible individuals could be having conflicting feelings on their own.
So if the consumer powers this economy and is responsible for the majority of what we see in economic activity, then what does it mean for consumers to say that to you? Does it mean they pull back on spending?
Well, I think theoretically, right? Yeah, that's what we've been looking for, is this negative sentiment to bleed into the spending data, and we haven't. And we know that's because asset holding consumers are the ones continuing to spend, no matter where they're spending. I do think, though, the longer that this negative sentiment goes on, paired with what we're seeing in the chilly labor market, in the chilly housing market, these things that hold people in place, the more that's going to spread and could eventually leak into the spending data. Now, does today's flat retail trade growth indicate the beginning of that trend? It remains to be seen. We need more data to say that for certain, but it could be.
The other thing I would say is, going back to the holidays, that's when people dig deep and they'll even go into debt because it's the holiday season. You kind of make exceptions and then you kind of cut back, maybe in the rest of the year. So to see the spending kind of trail off makes me wonder what? I don't know. Is it more important because of the timing of that retail number?
Yeah, that's a great question. So the timing has something to do with it. And also that's why I'm looking at those retail numbers with a grain of salt too. They are adjusted for seasonal and holiday differences. The more seasonal and holiday differences you have in a given month, the more overcorrection or undercorrection you might see in that seasonal adjustment. So it's important to take 1 month of data with a grain of salt. The other thing to think about is, how are they paying for it? We know from data that just came out today that the share of delinquent credit card balances is at nearly 13%, and we haven't seen that since 2011. So I think there's no doubt that there is an increasing burden on American households. How that plays into the larger economy remains to be seen.
Okay, so if that's one of the important signals that you're watching, what's another signal to watch if the consumer is stressed? We saw in the month of January, the most number of layoffs going back to the financial crisis.
Yeah, so I believe the data source you're referencing is Challenger, Gray, and Christmas. Mm-hmm. That's another one I caution people about reading too much into, because it does look at announcements rather than actual layoffs. They had a huge number last October. I believe back then it was the highest number of layoffs since 2003, but that never made it into the official layoff data. So announcements are quite different than actual layoffs. I do look at actual layoff numbers from the BLS, but definitely debt numbers, debt delinquency, those are the ones I look at for household household financial resilience.
Okay.
Listen, I understand what you say about exceptions to data and seasonality, but it's how you guys all make decisions. Everybody makes decisions. So, what is the data that says to you, here's what the economy's doing, or do you not have a clear picture and just got about 30 seconds?
Yeah, well, I think right now, and especially within the past few years, it's very, very difficult to get a clear picture. So much has been going on with the data. So much has been changing.
President Trump thinks we can get 15% with a different Fed chair. Do you buy that real quickly? I guess not.
No, I think when we bring this up.
I mean, he is the president. He sees a lot in terms of the economy.
Right. I'll echo what your previous guest said, and that